So the markets are an ever-changing beast. You constantly need to refine your process and make sure that the traditional ideals that you may have are still relevant today. As you can see, we don't put a lot of emphasis on the exit side. So in this video, I'm going to go over the biggest mistakes that happen on the exit side, especially with stop losses and how to fix them. Now, before we get into the video, here's a word from our sponsor, Masterworks. So Masterworks is a platform that allows you to invest into contemporary art. So the total wealth held in art is estimated to be $1.7 trillion, and 2/3 of billionaire collectors allocate between 10 and 30% of their overall portfolios to art. Also, contemporary art prices have outpaced the S&P 500 total return by 174% between 1995 and 2020. So Masterworks has emerged to be the only platform taking billionaire art collectors head on and lets you access their exclusive investments. Simply put, you can invest in the very same art they do by names like Banksy, Monet, Basquiat, and other iconic artists for just a fraction of what they pay to purchase. Very easy to start with Masterworks. It takes a couple clicks, visit their website, create an account, browse their artwork, and you can diversify your portfolio with one of the most stable assets around. Also, Masterworks offers a secondary market. So if you don't want to wait until they find a buyer, you can sell your shares to another member, similar to how you would sell stock on an app like Robinhood. Especially with how volatile the markets have been lately, this is the best time to be more diversified. So might as well jump into some contemporary art. Now, there is a wait list, but you can skip that wait list and immediately start investing by clicking the link in the description. It also really helps support the channel, so go and check it out. So back to the education side of things. So one of the biggest mistakes that I see that happens early on, it is utilizing stop losses as an end-all be-all system, where that is your only strategy of exit, especially when things go wrong. So if you think about when it comes to entries, a lot of times we have a lot of criteria that we have when it comes to a chart setup, indicators, level 2 time and sales. We need to see this, we need to see that before we even press a button to buy. But when it comes to exit, a lot of times we just set an arbitrary target on the upside. We set some form of downside risk, let a computerized order take care of everything, and we just let the trade go. And I think that it's almost oversimplified. Now, this is the key here. Stop losses should be used in the beginning when you're first starting to learn some form of consistent way of trading. You have to build up some discipline there. If you don't use a stop loss whenever you first start, a lot of times you mentally trick yourself to say, the stock is going to come back up. It's going to come back up. It's going to come back up. And when you could have sold for a 2% loss, now you're up 8% downside, 10% downside, 12% downside, because you haven't learned yet to really take initiative and exit a position. Now, once you get to a certain point in trading, well, I find that especially once you get past those initial hurdles of learning the systems, then the problem arises where stop losses have this bad side effect of really being stupid. So for example, a stop loss in itself is a computerized order where you have a trigger price and then you have an execution price. So the trigger price is going to be whatever you set as a threshold of either it equals or it goes below this point, it's going to execute that stop loss. Now the execution price can either be a market order, so it could be a market sale price. It can be a limit price, which is a little bit sketchier depending on if you're trading very volatile stocks, because remember, when things are going downwards, what do we want to prioritize? Do we want to prioritize preciseness with a limit order, or do we want to prioritize just getting the hell out of the trade? So you can see that sometimes market orders are going to be the better solution. If the company has good volume, very tight spreads, you're not really going to be missing out on much. Now, since stop losses are dumb orders, they have no way of referencing the chart and looking at how the trend is developing and being able to give some leniency. For example, let's say we have a stop loss set at a certain point. It can be very, very easily that the stock can quickly devalue on a large seller that looks to exit. People buy the cheap dip on the trade, it rebounds back up, but your stop loss gets executed in the meantime and you lose out on that position there that can continue to run. Happens all the time. So stop losses shouldn't be your primary exit when it comes to things going wrong. It should be a secondary point. The way that I trade is I have my stop loss at a secondary level, which is just going to be okay in an extreme case of a downfall. But whenever things start to go against me, then I start to plan an exit for a loss. Like it's a weird concept. Like a lot of times when you think about planning an exit, you always think about profit. But sometimes I plan exits for losses. Like if a company is obviously the trend is starting to reverse on me, I may sell half my shares for a loss, looking for a rebound. And as that rebound can develop, I can mitigate that loss to a degree where it's not going to be gruesome or it's not really going to affect me all that much. So you have to plan to scale out of certain positions. And this is why, especially now, I try to preach that you really don't want to try to play the genie route where you try to predict exactly where the perfect price of exit is going to be. You want to progressively do this. You want to, whenever you reach a certain target, sell half your shares or a third and progressively sell off your position. Most of the brokers that you trade with are going to be commission free. So you're not going to be adding on any more cost of the trade. And also scaling out doesn't affect the PDT rule. So if you're trading under 25 grand, you're not going to be adding more and more, using up all your day trades, which is a very large factor as well, especially with smaller accounts of new people that are getting into the markets. But in the majority of scenarios, you need to be able to take initiative to exit while things are going against you. And that is just the best way to look at it. I think a lot of people make the mistake where they just look at a stop loss as the end all be all. And whenever you're constantly getting false stopped out of a trade that is actually good, it ends up working against you. And that's just kind of how it goes. You just have to change that mindset, practice and change that mindset.